Strong numbers from our weekly jobless claims. Look at this. These guys are down to 432,000. Isn't that interesting? Now it's the lowest level in a year and a half. Earlier this month, Federal Reserve officials said labor market deterioration was lessening, and now they're planning to keep interest rates near zero. Doesn't make any sense to me, but the question is, does the Fed have the right plan for 2010? Joining us now, distinguished, highly esteemed former Dallas Fed president and CNBC contributor Bob McTeer, highly esteemed Mark Vittner, senior economist at Wells Fargo Securities, and equally highly esteemed CNBC's Rick Santelli. Gentlemen, it is an honor and a pleasure and a blessing to have you all. I just want to go to Mark Vittner. Mark, I'm going to make this case again. You react to me. The Fed is operating an emergency policy of zero interest rates and a bloated balance sheet pumping in those dollars. But the emergency is long over, Mark. What should they do?
Well, it's still a pretty dangerous neighborhood, and they've got a lot of non-traditional easing moves that they need to reverse before they start bumping interest rates up. But I think you're right, Larry. I think that policy's probably a little too easy given the environment that we're going to see in 2010, but they have to see some results before they take any action.
And Rick Santelli, there looks to me like there's a interest rate revolt against the Fed. This is one of the little themes in the last few weeks of this year across the spectrum, as you know better than anybody. Treasury rates are now up, what, about 60-some-odd basis points, Rick Santelli? Will the Fed listen to the bond market, which is signaling that they need to raise their own rate and stop their ballooning balance sheet? Will they listen to rates, Rick? They won't listen to me. Will they listen to interest rates?
Well, I don't think they're going to listen to the markets, and I don't think they can understand the language the markets speak. But to be clear, we're up 164 basis points on the year on a 10. We're up 200 basis points or close to it on a 30. And even if you believe the numbers today on claims and the seasonal adjustments for holidays, let's say it's true. Now, a lot of people have upgraded based on that. Their jobs number for a week from now into positive territory. So why exactly do you think, Larry, that the stock market's now down 42 points? One of the reasons, a flattening curve with all maturities rates moving up and higher rates in general. So even good news in the labor market, should it materialize, could be a real banger for the stock market in terms of the notion that even economic data can't sustain itself. Debt will sustain the debt issuance, and higher rates aren't going to be a big positive in this environment.
It's going to be tough to really read too much into such of a low-volume move on a day like today. But let's bring in Bob, because you've been on the inside. You heard what's been said so far. If labor trends continue this way and the 10-year note continues to hike, can the Fed maintain their language and their stance amid that kind of pressure?
I think the improvement in the labor market might cause them to change their language earlier than they otherwise would. I don't think they will regard the higher, longer-term interest rates negatively. It could be a reflection of inflationary expectations, but I think it's more likely an expectation of a stronger economy. So the stronger economy and the improved labor market would be good for Fed policy.
Bob, we can look at that. Actually, I did the distribution with the 60 basis point rise, and I used the 5-year note rate as a sort of midterm for the yield curve. 35 basis points was a hike in the inflation expectations from the tip spread, and 26 basis points was real interest rates. So you got both better growth and higher inflation expectations in the hike in long-term, medium and long-term rates. And as Rick said, the 2-year note, will the Fed listen? I mean, Bob McTeer, my question to you is a straightforward. With Helicopter Ben, we know he knows how to ease. Does he know how to tighten?
I think he's read about tightening and he's heard of it, so I think he can probably do it.
Yeah, but he's never done it. That's the question. I agree, he reads a lot. I'm not saying he ain't a smart guy, Bob McTeer, but the fact is he's never really tightened.
His study of the Great Depression tells him that the dangers of premature tightening are greater than the dangers of staying easy a little too long. However, I do think that they are going to be adjusting policy earlier than they had expected a short time ago, because the economy is doing very well.
Yes, it is. We're in a mini boom
situation.
Mark,
what about a scenario, and again, if this is too simplified, then correct me if I'm wrong, the banks are sitting on this money, they're sitting on it, they're not using it. What if they start to use it and lend it out, and then the velocity speeds up, and then all of a sudden inflation is an issue? I mean, people aren't really talking about the fact that the money's not being used. Once it does, that inflation could pop up in a hurry.
Well, I don't know how quick that transition is likely to occur. I mean, we've got a lot of businesses that have some cash on their balance sheets. They're going to be able to go there before they start borrowing. And I think that there's probably going to be time for the Fed to react before lending begins to really pick up. And any pickup in lending is probably a little bit down the road. It tends to be a little bit of a lagging indicator. So I'm not so sure that that's something that we have to worry about. But I think that the bigger issue is going to be politics. The unemployment rate, even though the economy is getting better, the unemployment rate's likely to head higher. And we're not going to create enough jobs to reduce the unemployment rate until the second half of next year. It's an election year. There's all sorts of political battles about the Fed's independence. It puts them in a tough spot.
Yeah, but Mark Vintner, let me ask, what are you boys looking for down there? I mean, what if you get 4 to 5% economic growth in Q4 and Q1 and Q2? What if you get positive jobs? You know, I think you're looking at a positive jobs number for December. We'll get that next week. November could be revised up. The first quarter, you could produce 75, 100,000 jobs a month. What are you boys looking at, Mark Vintner here? I'm not sure I like the sound of this story.
Well, we need a lot more jobs than that. But when it's all said and done, we probably will have lost 8.5 million jobs in the recession. 2.5 million people dropped out of the workforce. Our population growth creates a need for us to create 125,000 jobs just to keep the unemployment rate in check. And when you add it all up, we're going to need to add somewhere around 200.